back to Iron Financial. You're here to forge a stronger portfolio, and we're here to help you do it by stress testing the big stories out there. I'm your lead analyst, and of course, I've got our market skeptic here to keep me honest. Today, we're putting Unusual Machines, that's ticker UMAC, under some serious pressure. Now, this company is right in the eye of the hurricane, a supercycle in the American drone industry that's being fueled by some major geopolitical shifts. They just dropped their full year 2025 earnings, and believe me, the headline numbers are lighting up Wall Street. But our job isn't to get blinded by the hype. We are going to break down their financials piece by piece, separate the structural steel from the scrap metal, and figure out if UMAC is really building America's next defense titan, or if its foundation is about to shatter under the weight of its own ambition. So to really get your head around the sheer size of what's happening here, you've got to start with this quote from the CEO, Alan Evans. Look, he's not just talking about some market opportunity. No, he is literally describing a fortress, an economic fortress being built by Washington, D.C., with UMAC perfectly positioned to become one of the primary armorers. You have to understand, for years, foreign companies, mostly from China, completely dominated this space. But now, the entire landscape has been violently re-engineered by legislation. The regulators have basically built a wall around this entire industry. We're talking about a $10 billion market where the main suppliers have been kicked out. Right at the same moment, the U.S. government is demanding a massive ramp-up in domestic production. This is a gold rush, plain and simple. And UMAC? They're selling the picks and shovels, the motors, the guts, the critical components every single drone maker inside that fortress is going to need. So this isn't just a tailwind. This is a Category 5 hurricane at their back. A Category 5 hurricane, huh? You know, hurricanes also have a nasty habit of blowing down poorly built houses. I'm the market skeptic. And look, while a $10 billion protected market sounds like an absolute dream for an investor, a great story doesn't always equal a great investment. It's my job to ask the tough questions that all the excitement tends to drown out. So, is this growth actually real? Is it sustainable? Or is it just a mirage that's being fueled by something that, maybe investors should be a little bit worried about? Are they forging a true fortress? Or is it more like a hollow movie set, just painted to look like solid steel? Now, the bull case you're about to lay out, it's powerful. I've seen the numbers. But we're grabbing our hard hats and we are going to inspect the financial blueprints. Because let me tell you, when you build this fast, even a tiny hairline crack can lead to a complete and total structural collapse.
All right, that's a fair challenge. So, before we go looking for those cracks, let's build out that bull case brick by powerful brick. We have to start with the raw power of their top-line numbers. Because this, right here, is the story that has the market completely captivated. And yeah, on the surface, it's a picture of just overwhelming strength and momentum. We're going to look at three core pillars of this growth engine. First, the pure revenue explosion. Second, a fundamental strategic business transformation. And third, a balance sheet that looks less like a company's and more like a bank vault. So let's kick it off with the number that's grabbing all the headlines.
101%. Just let that sink in for a second. That is their full year revenue growth for 2025. I mean, in any industry, doubling your sales year over year is a massive achievement. But for a company that physically manufactures hardware, it's almost unheard of. This isn't some software company just flipping a switch to add more subscribers. No, this is a company that is building, assembling, and shipping twice as many physical products as they did just the year before. This is the first and honestly the most potent piece of evidence that this market demand isn't just a story. It's translating into millions and millions of dollars flowing right into the company's top line. And when you look at it visually, well, the story gets even starker. You can see it clear as day on this chart. Back in 2024, they posted $5.6 million in revenue, a really solid number for a small growing company. But then look at 2025, they just blasted past that to $11.2 million. The bar on this chart has literally doubled in height. This isn't some slow incremental progress we're talking about. This is a step change. It's a fundamental shift in the scale of the entire operation. It's like the first massive structural beam they've slammed into place, proving that they can execute and actually meet that surging demand. But you know what? That annual number doesn't even tell the full story of the momentum they have right now. The real power is in the acceleration. Take a look at this, 133%. That's the sequential revenue growth, just from the third quarter to the fourth quarter of 2025 alone. They jumped from $2.1 million in Q3 to nearly $5 million in Q4. This is such a critical data point because it shows that the growth isn't just happening, it is speeding up. It's proof positive that the operational investments they made mid-year, hiring engineers, expanding facilities, are now paying off big time.
They didn't just end 2025 growing, they exited the year at what looks like escape velocity. This isn't a train hitting its cruising speed, it's a rocket hitting stage 2 ignition. And this isn't just about selling more parts, it's about a calculated strategic transformation of the entire business. Just look at this timeline. In the first quarter of 2025, only about 31% of their revenue came from enterprise sales. So back then, they were still fundamentally a high-end consumer retail business. But just watch this disciplined pivot throughout the year. 48% in Q2, 57% in Q3, and then a massive jump to 81% in Q4. This is the company in real time evolving from just an online storefront into a serious industrial-grade domestic manufacturer that's supplying major defense and enterprise clients. And that shift is absolutely vital, because those enterprise contracts, they're larger, they're more stable, and ultimately they carry much higher margins. They are building a higher quality, more resilient business right before our very eyes. So the big question is, how are they financing this incredible ramp up? Are they taking on a mountain of debt? No. They are financing it with this, over $103 million in cash and equivalents just sitting on the balance sheet. And look at that subheader, zero debt. This right here is the definition of a fortress balance sheet. In an economic environment with high interest rates where capital is tight, UMAC has a war chest. They don't need to go ask the banks for permission to do anything. They have the financial firepower to build out new factories, to hire the best talent, and to aggressively stockpile inventory to get way ahead of the competition. This isn't just a safety net for them. It's an offensive weapon. Okay, so let's just summarize the bull case. You've got an explosion in top-line revenue. You've got a strategic pivot to a stronger, more profitable business model. You have a vault full of cash and absolutely no debt. And the final piece of this puzzle is that the market itself is being engineered for their success. The FCC has banned new foreign parts. The key Chinese competitors are on the entity list, which means they're blocked from the US market. And on the demand side, you have the DoD's Drone Dominance Program. That's a public mandate to buy tens of thousands of drones. The CEO himself projects this creates a $90 million addressable market for them this year alone, and that jumps to $250 million next year. The engine is built, the tank is full of high-octane cash, and the government has basically paved a 6-lane highway just for them. It looks unstoppable. Unstoppable. Now, that is a heavy word. And I'll give you that. The bull case is strong. It's a beautiful, gleaming structure that's reaching for the sky. But my job is to ignore that gleaming facade and get down into the basement with a flashlight to check for cracks. Because every beautiful skyscraper has a foundation. And if that foundation is compromised, I don't care how tall it is, the whole thing is coming down. It's time for the stress test. We're moving past the glamour of that revenue line, and we're going deep into the plumbing, the cash flow statement, the income statement, and we're going to find out what's really holding this entire structure up. And that brings us to the single most important question you can ask about any of these high-growth companies. $100 million in the bank, revenue doubling, it all makes for a beautiful story. But who is paying for it all? Who's paying for the steel, the concrete, the labor? Is the business itself generating the cash it needs to fund this relentless expansion, or is that money coming from somewhere else entirely? Because the answer to that question, well, it changes everything. It's the difference between a self-sustaining economic engine and a Hollywood movie set that's just being propped up from behind. And here it is. Here's your answer. This slide right here exposes the first massive crack in the foundation. Just look at the top line. Cash from operations for all of 2025. It's negative. They burned through $5.6 million just running their day-to-day business. The company's core operations are not profitable. They are actively losing money. So where did that $100 million war chest come from? Look at the second line, $157.8 million. That's how much they raised from selling new shares of the company. Let's be crystal clear about what this means. They are not funding their growth with profits from their business. They are funding their growth by selling off pieces of the company to new investors. The growth engine isn't running on the fuel it creates itself. It's running on fuel that's being pumped in from the outside. So what does raising nearly $160 million by selling stock actually mean for someone who already owns shares? It means dilution, massive, overwhelming dilution. From 2024 to 2025, the number of shares out there more than tripled, from about 8.3 million to 26 million. Think about it like this. Imagine it's a pizza. In 2024, you owned a slice of a pizza that was cut into 8 pieces. By the end of 2025, they took that same pizza and they cut it into 26 pieces to feed all the new investors who just gave them money. Yeah, the pizza got bigger, sure, but your individual slice is now just a tiny sliver of what it used to be. Every share of stock you own now represents a much, much smaller claim on the company's future profits. And this right here reveals the true cost of that amazing revenue growth. The bull case celebrated revenue doubling, but what happened to the bottom line while the top line was exploding? This chart shows the loss from operations. In 2024, they lost $17 million. Okay, but in 2025, the year of unstoppable growth, that loss didn't shrink, it didn't stay flat, it ballooned by nearly 50% to over $25 million. So while the front door was flooded with all this new revenue, the back door was wide open, and they were just hemorrhaging cash. This is not efficient growth. This is growth at any cost, and that cost is getting steeper and steeper. So where is all that money going? Well, let's drill into their operating expenses. The total was about $29 million. But just look at that one dominant slice of the pie, general and administrative, or G&A. A staggering $23.9 million. It completely dwarfs the actual cost of operations, of sales, of everything else combined. And buried inside that G&A number is another huge red flag. $15.6 million of it was non-cash, stock-based compensation. Now, non-cash sounds harmless, but it's not. It's how these growth companies attract top talent without burning through their cash. But it is a very real cost, and it's paid by the shareholders. It means they are literally printing new shares to pay their team, which leads to, you guessed it, even more dilution. They're preserving the cash in the bank today by writing IOUs against future shareholder value. So you've got a company that's cash flow negative, funded entirely by dilution, with widening losses and bloated expenses. Maybe it gets better from here, right? Well, don't take my word for it. Let's just hear from the CEO himself. He's talking about gross margins, which right now stand at a pretty decent 35%, but he is explicitly warning investors on the earnings call that he expects those margins to get worse in the near term. His exact words were, "Our worst gross margins will likely hit in the first half of 2026. The captain of the ship is telling everyone that they are sailing directly into rougher waters as they struggle with the immense costs of scaling up. Even the one potential bright spot in the income statement is about to get dimmer." Okay, you've landed some solid punches. You've definitely identified some very real, very significant cracks in the foundation. On one hand, the bull case presents a structure of just incredible potential, powered by explosive growth and this massive protected market. But on the other hand, the bear case reveals that the entire operation is being funded by shareholder dilution, losses are accelerating, and management itself is warning of more pain to come. So now we have to put it all on the blueprint. We have to reconcile these two opposing forces and deliver the final verdict. Is this structure sound enough to weather the storm and reach its potential, or are these cracks going to bring the whole damn thing down? Let's just lay it all out. The foundation, that's the bull case. It's built on undeniable strengths. That top-line growth is real, you can't argue with it. The balance sheet with over $100 million in cash and zero debt, that is a powerful weapon. And that government-protected market is about as close to a sure thing as you can get in investing. They are a clear leader. But the cracks you've highlighted are just as real. The net losses aren't just significant, they're growing. The whole operation is being bankrolled by selling stock, which is a direct cost to every single shareholder. Management is guiding for margin compression, and really, it all just boils down to one thing: immense execution risk. They have to perfectly manage an incredibly complex and expensive manufacturing scale-up, and they have to do it before that big pile of money runs out. And that brings us to the absolute bottom line. An investment in UMAC today is not a bet on the American drone market. That bet is a near certainty. The demand is gonna be there. This is a bet on this specific management team. It's a bet that they can take that $103 million war chest and flawlessly execute a brutal transition from a cash-burning, dilutive machine into a profitable, self-sustaining manufacturing titan. They have a finite runway. That cash will not last forever, especially not with losses running north of $25 million a year. So the key metric to watch going forward isn't revenue growth. It's cash from operations. You need to watch for the quarter that number finally turns from negative to positive. That, and only that, is the signal that the foundation is starting to solidify. And that leaves you, the investor, with the final billion-dollar question. There is no doubt that Unusual Machines has forged the steel frame of a potential American industrial champion. The opportunity in front of them is historic. But the financial pressures are immense, and the operational hurdles are enormous. So will they successfully build out the rest of that structure, turning that cash into a profit-generating machine before it's too late? Or will the constant need for capital, the widening losses, and the intense pressure of execution cause the entire structure to buckle and collapse before it's ever truly finished? That's the question you have to answer. Thanks for joining us on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.